Ever wondered what the biggest mistake beginners make in investing? It's not what you might expect. When we talk about investing, we often think about numbers, charts, and complex strategies. We imagine a world of fast-paced decision-making and high-stakes gambles. But in reality, investing is a field as diverse and nuanced as any other. It's a labyrinth of potential pitfalls and golden opportunities. One of the most significant, and perhaps surprising mistakes that can be made in this game isn't about numbers or strategies. It's not about getting the math wrong or misunderstanding the market trends. It's a mistake that is much more human, much more relatable, and unfortunately, much more damaging. This mistake is so common, yet so overlooked, that it often slips under the radar, wreaking havoc on promising investment portfolios. So, what's this costly mistake? It's allowing emotions to guide investment decisions. Imagine this. You're a beginner investor, excited about stepping into the world of stocks, bonds, and assets. Your heart is brimming with optimism and your mind buzzing with strategies. You've spent countless hours researching, poring over financial news and analyzing market trends. You're ready to dive into the vast ocean of investing, armed with your hard-earned savings. You start off by investing in several stocks that seem promising. The tech startup that's been making headlines, the reliable blue-chip company that's been around for decades, and the exciting green energy firm that's set to revolutionize the industry. You're confident that you've made the right choices, and you wait for your investments to grow. But then, the market takes an unexpected turn. Your stocks start to plummet. The numbers on your screen turn red, and your heart starts to pound. Panic sets in. You think about the money you could lose, the dreams you might have to give up. So you do what seems like the only logical thing. You sell. You sell everything, hoping to cut your losses. You breathe a sigh of relief. You've escaped, you think, but then, as quickly as they fell, the markets rise again. Your stocks, the ones you sold in a panic, are now soaring. You watch in disbelief as the prices climb higher and higher, far beyond what you sold them for. Regret washes over you. You hastily buy back the stocks, but now they're more expensive. You've lost money, not due to poor investment choices, but because you let your emotions cloud your judgment. Fear made you sell low, and regret made you buy high. This investor let their emotions, specifically fear and regret, dictate their decisions, leading to a loss. But how could they have avoided this? The story of our beginner investor brings us to some crucial points about investing. In the journey of investing, it's easy to get swayed by the waves of emotions. Fear and greed, the two powerful sentiments, often end up dictating our actions, leading us down a path of impulsive buying or selling. But this, dear listeners, is where we need to pause, reflect, and recall the lessons from our beginner investor's story. Investing is not a sprint, but a marathon. It's a long-term game where patience and discipline are the real winners. The importance of rational analysis in decision-making cannot be emphasized enough. It's not about the adrenaline rush of making a quick buck, but the slow and steady growth of your portfolio over time. A disciplined approach to investing is like the North Star in an investor's journey. It helps you navigate through the choppy waters of market volatility without losing sight of your destination. This approach involves setting long-term goals, devising a clear strategy, and most importantly, sticking to it. It's like setting a course on your GPS before you start a journey. It keeps you focused, prevents unnecessary detours, and helps you reach your destination. Market volatility is a given in the world of investing. It's like the weather, unpredictable and ever-changing. But just as we don't abandon our travel plans because of a sudden downpour, we shouldn't let market volatility deter us from our investment goals. Sticking to your strategy, even when the market seems to be in a freefall, is key. It's about keeping a cool head when everyone else is losing theirs. In essence, investing is a delicate balance between the mind and the heart. It's about making informed decisions based on rational analysis and not getting swept away by the tidal wave of emotions. It's about staying the course when the going gets tough and celebrating the small victories along the way. Remember, in the world of investing, emotions are not your friend. So, keep calm, stay disciplined, and let your strategy guide your decisions, not your fears or regrets.